Silver pushing above the high 60s and pressing into the low 70s is not exciting because it feels good. It's exciting because it forces a hard question most people have avoided for years. If silver can sustain this level, then a decade of dismissing it as dead money was not caution. It was complacency. What matters here is not celebration. It's context. Silver didn't wake up one morning and decide to run. This move is happening while liquidity is tight, real yields remain unstable, confidence in paper claims is thinning, and capital is quietly rotating away from assets that require perfect conditions to survive. That combination matters, and it doesn't show up in memes or headlines until it's already too late. Most people only pay attention when price validates a story for them. That's not preparation, that's reaction. Silver has always been a market that punishes late certainty and rewards early discomfort. When it's quiet, nobody wants it. When it moves, everyone suddenly always believed. Here's the uncomfortable truth. If you are only interested in silver now because the price is pressing higher, you are already behind the curve mentally, even if you're not behind financially yet. Price is the last signal, not the first. By the time silver is obvious, the asymmetry that made it interesting is already shrinking. This move isn't happening in isolation. Gold has already repriced. Risk assets are wobbling. Liquidity is selective, not abundant. Industrial demand is not hypothetical anymore. It's contractual. And silver sits in the middle of that collision, forced to behave both like money and like a raw material at the same time. That dual role is not a feature you can turn on and off. When it activates, volatility follows. There's also a dangerous assumption floating around right now, that because silver is moving, it must keep moving straight up. That's wrong. Strong trends don't remove risk. They concentrate it. When silver breaks into new price territory, the market isn't celebrating. It's renegotiating value in real time. That process is violent, fast, and unforgiving to people who confuse conviction with certainty. Another reality people don't like hearing. Silver does not care how long you've been right. It doesn't reward loyalty. It rewards positioning. If your thesis cannot survive pullbacks, liquidity shocks, or failed breakouts, then it was never a thesis. It was hope with better branding. And yet, despite all of that, silver is doing something important. It's forcing attention. Not because it's trendy, but because it's small. Compared to gold, the silver market is thin. That means flows matter. Rotation matters. Timing matters. When money moves into silver, it doesn't tiptoe. It slams doors. The real question isn't whether silver can trade above 70. The real question is whether this move marks the start of a longer repricing cycle or just another volatility event that flushes out weak hands before the next leg. That distinction decides everything for traders and long-term holders alike. Silver doesn't move in a vacuum, and pretending this is just a silver story is how people miss what's actually happening underneath. The background matters more than the breakout itself, because price is reacting to pressure that's been building for years, not weeks. Start with liquidity. For most of the last decade, markets were conditioned to believe that liquidity would always return, always expand, always bail out bad positioning. That assumption is breaking down. Central banks are trapped between inflation credibility and financial stability, and neither outcome is friendly to real purchasing power. When liquidity becomes selective instead of abundant, capital stops chasing stories and starts seeking insulation. That's where silver re-enters the conversation, not as a trade, but as a constraint. At the same time, the global system is quietly repricing risk. Sovereign debt levels are no longer theoretical. They are mathematical. Servicing costs matter again. Currency stability matters again. Trust in intermediaries matters again. This isn't about panic yet, but it is about fragility. And fragile systems tend to expose the assets that were ignored because they didn't produce yield or headlines. Silver's position is uncomfortable for traditional models. It's too monetary to be treated like copper and too industrial to be treated like gold. That ambiguity is exactly why it gets mispriced. Institutions prefer clean categories. Silver refuses to stay in one. When industrial demand tightens supply and monetary demand tightens float at the same time, models break. That's when price stops behaving politely. There's also a timing issue most people misunderstand. Silver does not lead cycles. It lags, then accelerates. Gold moves first as a confidence hedge. Silver follows when participation broadens and leverage creeps back in. That doesn't make silver safer. It makes it more reactive. If you don't understand that, you mistake volatility for manipulation or inevitability, depending on your bias. Another hidden angle is participation. Retail flows into silver are emotionally driven, but institutional flows are constraint-driven. When allocations are forced rather than chosen, price behaves differently. You don't get smooth accumulation. You get air pockets, sharp advances, and sudden retracements. That's not bullish or bearish by default. It's structural. There's also a myth that silver needs a crisis to work. It doesn't. What it needs is pressure. Pressure on margins, pressure on currencies, pressure on supply chains, pressure on confidence. We are already there. The difference is that most people are still waiting for a headline event to justify action. By the time that happens, silver will no longer be cheap in any meaningful sense. Now challenge this assumption directly. Everyone knows silver is undervalued. No, they don't. If they did, positioning would look very different. Silver remains a tiny market relative to global capital pools. That's not bullish by default, but it explains why moves are exaggerated once they start. Thin markets don't absorb flows gracefully. Another uncomfortable truth: a rising silver price does not mean everyone is right. It means the market is testing narratives. Some will break, some will survive. The people who survive are the ones who understand why silver is moving, not just that it is. This is where most commentary fails. It treats silver like a belief system instead of a market. Markets don't reward belief. They reward preparation, flexibility, and risk awareness. Anyone telling you silver is guaranteed has already disqualified themselves. What matters now is structure. Where demand is coming from, how supply responds, how leverage behaves as price pushes into unfamiliar territory. Without that, excitement is just noise. This is where emotion has to step aside, because the chart does not care about conviction. It only reflects positioning, momentum, and risk. If silver is going to justify higher prices, it has to do it structurally, not symbolically. First, understand what kind of market this is right now. Silver is in price discovery above a long-standing regime level. That does not mean it goes straight up. It means historical resistance offers less guidance and momentum becomes the dominant force. In these phases, moving averages matter less as support and more as gauges of trend health. Price holding above rising medium and long-term averages tells you buyers are still in control, but it does not protect you from sharp volatility. The most important level psychologically was the 70 handle. Not because it was magical, but because it represented a transition from remembered prices into unfamiliar territory. Once that level was accepted, the market shifted from asking, "Can it get here?" to "How much risk is left if it stays here?" That shift is subtle, but critical. Acceptance above prior congestion is what separates breakouts from failed spikes. Above that zone, resistance is not a line, it's a band. When price pushes into the low 70s, supply does not appear all at once. It leaks in. Profit-taking, hedging, and short-term selling pressure gradually test whether demand is real or emotional. Strong markets don't collapse there, but they do pause, compress, and shake out weak hands. On the downside, the mid to high 60s are not just numbers on a chart. They are the area where this move either proves itself or exposes fragility. A controlled pullback that holds that zone would signal continuation. A fast loss of that area would tell you the move was more positioning-driven than conviction-driven. That distinction matters more than any price target. Momentum indicators right now are elevated, not broken. That's a warning, not a sell signal. Extended momentum can stay extended far longer than people expect, but it also means entries matter. Chasing strength without a plan is how people turn bullish theses into losses. Strong trends reward patience, not urgency. Now consider scenarios, not predictions. In a bullish continuation scenario, silver consolidates above prior resistance, volatility contracts, and volume remains constructive. That sets the stage for another expansion leg. In a neutral scenario, price chops, frustrates both sides, and bleeds momentum without breaking structure. In a bearish scenario, silver fails to hold the upper 60s, momentum unwinds fast, and late buyers are forced out. Notice what's missing from that list. Certainty. There is none. Anyone pretending otherwise is not doing analysis. They are marketing confidence. Another critical mistake people make here is ignoring leverage. Silver is highly sensitive to futures positioning and paper flows. When leverage builds too fast, even strong trends can snap violently. That doesn't invalidate the long-term case, but it can destroy short-term accounts. The chart is not telling you to celebrate. It's telling you to respect risk. Price discovery is opportunity, but it's also exposure. If you don't know where you're wrong, you don't have a position. You have a hope. When you zoom out far enough, the short-term noise starts to look irrelevant. And that's where silver becomes uncomfortable again. Because on a long-term basis, it refuses to fit neatly into the narratives people want to believe. Compared to most financial assets, silver has not enjoyed a multi-decade repricing cycle. Stocks have. Real estate has. Bonds did until they didn't. Even gold has already gone through a structural revaluation. Silver has lagged, not because it lacks value, but because it sits at the intersection of monetary trust and industrial necessity. That intersection is slow to activate, but powerful when it does. This is where the comparison with gold matters. Gold is primarily about confidence. Silver is about function. Gold protects against systemic failure. Silver exposes systemic strain. When industrial demand rises at the same time monetary demand returns, silver doesn't just hedge risk, it highlights imbalance. That's why its cycles are shorter, sharper, and more emotionally charged. Relative valuation tells the same story. On a historical basis, silver remains cheap compared to gold, not because markets are stupid, but because silver requires broader participation to reprice. Gold moves with reserve managers and institutions. Silver moves when capital has already accepted the idea that monetary dilution is structural, not temporary. That acceptance phase is only just beginning. Another long-term factor people underestimate is supply response. Silver is not mined primarily for silver. It's a byproduct. That means higher prices do not automatically bring new supply online. Mining decisions lag price by years, not months. When demand shifts faster than supply can respond, volatility becomes the release valve. Cycles matter here. Silver historically underperforms early in monetary cycles and outperforms late, when confidence in policy fades and real assets reassert relevance. That does not mean every cycle repeats cleanly. It means silver tends to move when people stop believing that stability is permanent. Now confront another uncomfortable idea. Silver is not a hedge against everything. In deflationary shocks, it can suffer. In liquidity panics, it can get sold. Anyone claiming silver only goes up is ignoring history. What silver does offer is optionality in systems that are increasingly rigid and leveraged. Long-term holders need to understand that patience is not passive. Holding through cycles requires conviction grounded in reality, not slogans. Silver's long-term case is not about apocalypse or guaranteed wealth. It's about positioning in a world where monetary credibility is being tested incrementally, not overnight. For traders, this means respecting cycles instead of marrying trends. For long-term holders, it means understanding why silver belongs in a portfolio, not treating it like a lottery ticket. Both groups fail when they blur those roles. The most dangerous mistake right now is assuming that because silver has moved, the decision is already made. It isn't. Markets don't resolve structural imbalances in straight lines. They test participants repeatedly until only informed conviction remains. Silver's move into this phase is not a victory lap. It is a stress test. It is testing narratives, positioning, patience, and discipline all at the same time. The people who benefit from this environment will not be the loudest or the most confident. They will be the ones who understand why silver is being pulled higher and what could still go wrong. The biggest insight to take away is this: silver is not rising because it is loved. It is rising because the system around it is under pressure. Liquidity is selective, confidence is uneven, and capital is searching for assets that do not rely on perfect policy execution to justify their existence. Silver fits that role awkwardly, and awkward assets tend to move violently when they are finally forced into relevance. Another key point is that volatility is not a flaw here. It is the mechanism. Silver has always expressed truth through instability. When markets are calm and controlled, silver looks unnecessary. When stress builds and contradictions pile up, silver starts reflecting those tensions in price. That does not make it safe. It makes it honest. For traders, the lesson is simple but uncomfortable. Respect structure. Respect levels. If you cannot define where you are wrong, you should not be involved. Chasing strength without a plan is how strong narratives destroy weak execution. There will be pullbacks. There will be false breaks. Anyone pretending otherwise is selling certainty, not analysis. For long-term holders, the takeaway is different. Silver's role is not to outperform everything every year. Its role is to preserve optionality when monetary credibility erodes gradually, not dramatically. That requires patience and emotional control, not constant validation from price. It is also critical to reject the idea that silver is a one-way bet. It isn't. It never has been. It will frustrate you, test your conviction, and force you to question your assumptions repeatedly. That is not a reason to avoid it. It is a reason to understand it properly. The final risk people continue to ignore is complacency disguised as confidence. Believing you know how this ends is the fastest way to make mistakes. Markets reward humility, preparation, and adaptability, not slogans or certainty. Silver is not here to make you feel smart. It is here to expose whether you are disciplined. And before anything else is taken from this, it must be said clearly. This discussion is for educational and informational purposes only. It is not financial advice. Everyone's financial situation is different, and markets involve risk. Do your own research, understand your objectives, and make decisions based on your own analysis, not anyone else's conviction.